All right, let's break down the Travelers Q4 2025 earnings call. Now, on the surface, this was an absolute monster of a quarter, but the market's reaction? Kind of quiet. So, in this explainer, we're going to dig into why that happened, and more importantly, what the smart money is really focused on for the next call.
And we have to start right here with this number, $2.79. That's how much travelers beat expectations by, per share. The street was looking for about 834 in core earnings, and travelers came in and dropped a staggering 1113. I mean, that is a blowout by any definition, and it really sets up the central mystery of this quarter. And the strength was just everywhere you looked. GAAP EPS up a solid 23% year over year. Revenue beat by over $1 billion. But for an insurer, the metric that really tells the story is the combined ratio. It improved by 3 full points, all the way down to 80.2%. Now remember, anything under 100% means you're making a profit on your insurance policies. So getting down to 80, that is truly exceptional.
So, of course, management was quick to frame this as the new normal, not just some lucky break. CEO Alan Schnitzer used this exact phrase, adorable dynamic. And that's a clear signal to investors, right? He's saying that this powerful engine, great underwriting plus strong investment returns, is built to last. So what is this dynamic he's talking about? Well, management sees the whole business as this powerful flywheel. It's pretty simple, really. Step 1, their disciplined underwriting generates really strong profits. Step 2, they take those profits and fuel a growing investment portfolio, which then spins off even more income. And step 3, the big payoff. That cash gets funneled into aggressive capital returns for shareholders, and that just completes the cycle, letting them do it all over again. And when they say aggressive, believe me, they are not kidding. In Q4 alone, they bought back over $1.6 billion of their own stock. And now they're stepping on the gas even harder. They just sold their Canadian operations, and they're using that cash to guide for $1.8 billion in buybacks for just the first quarter of 2026. This is a company that is actively and seriously returning cash to its shareholders. Management also spent a good chunk of time on the call talking about their tech strategy. The CEO kind of framed it as two different chapters. You had Innovation 1.0, which was the last decade of building out their foundational tech advantages. But now, he says, they're entering Innovation 2.0. And this new phase is all about one thing, deploying artificial intelligence across the entire business. And look, this wasn't just some vague, futuristic talk. They gave real, concrete examples. They've got a new partnership with a top AI company, Anthropic, to make their developers more productive. Over half of all their claims are now eligible for straight-through, totally automated processing. And get this, they already have dozens of generative AI tools in production, being used by more than 20,000 employees. This isn't AI in theory. This is AI being put to work today. So this brings us right back to our big question. We've got a huge earnings beat, a super confident management team, massive buybacks, a real AI strategy. So why did the market basically just shrug its shoulders? The stock barely budged on the news, trading up less than 0.5%. What did the market see that the headlines didn't? Now, this is where it gets really interesting, because while the price was flat, the volume was anything but. Trading volume on earnings day was nearly double the 3-month average. So the market wasn't ignoring the results at all. It was intensely debating them. A whole lot of shares were changing hands, but they were doing it at pretty much the same price.
And here's what the big institutional investors were thinking. First, they cat normalized the results. See, it was a really quiet quarter for catastrophes, only $95 million in pre-tax cat losses. That's a massive tailwind, sure, but you can't count on that happening again. So the market almost instantly looked past the big beat and started focusing on the risks that lie ahead.
And this is exactly what they're focused on, managing future risk. Management is already preparing for the next big storm. For 2026, they've proactively beefed up their reinsurance coverage. They've lowered the attachment point for their main catastrophe treaty from $4 billion down to $3 billion. What that means in simple terms is their reinsurance kicks in sooner, giving them better protection for their balance sheet if a major event does hit. So what's our take for the next call? We're starting things off with a market perform rating. Look, there is no question that management is executing at an incredibly high level, but with the market already looking past the good weather and pricing in future catastrophe risk, we think all that excellent performance is now pretty much reflected in the current stock price.
Okay, let's look ahead and see what management has told us to expect for next quarter. They've given us some pretty clear guideposts.
They're looking for about $800 million in after-tax net investment income. As we mentioned, share repurchases are guided to a very strong $1.8 billion, and they're continuing to keep a tight lid on expenses, targeting a 28.5% expense ratio. So, what's the trade idea here? Well, given our view that the stock is fairly valued and probably going to be stuck in a range for a bit, one idea is something called a costless collar. Here's how it works. You buy a put option to protect yourself on the downside, and then you pay for it by selling a call option, which caps your potential gains on the upside. It's a strategy that basically profits from stability. It protects you from a drop and can even generate a small premium if the stock just stays flat, which lines up perfectly with the market's quiet reaction to these great earnings. As always, this is not financial advice. The trade idea we just talked about is for informational and entertainment purposes only. And that really leaves us with the key question as we head into the next call. Travelers is pouring money into AI to drive efficiency and get smarter about underwriting. The bulls out there believe this can fundamentally lower the company's risk and act as a shield against earnings volatility. The big question is, will AI prove to be a true game changer, a real competitive moat, or will its benefits just become another line item on the income statement that gets washed out by the next big hurricane season? That is what we'll be watching.